a crucial piece of legislation that affects businesses of all sizes. To provide us with a thorough understanding of the Corporate Transparency Act and the steps your business must take to remain compliant, we're honored to have Grant Stubbins from Stubbins, Watson, Bryan, and Witucky and Company, LPA. Grant's experience in employment law and employer disputes make him uniquely qualified to guide us through these new requirements and their implications. Grant has a BA, his undergrad from the University of Southern California, and his Juris Doctorate, where he graduated cum laude from the University of Akron School of Law. Grant, thanks for taking the time to share your insights with us today on the Corporate Transparency Act. I'll turn it over to you.
Thanks, Dana. Good morning, everyone. Corporate Transparency Act is something that was kind of sprung on us. A lot of people in the general public weren't even aware of it until very recently. It's sort of flown under the radar for a number of years, and now small business owners are surprised to find out that they're going to be subject to this law. So I wanted to kind of give a general overview about how it applies. We represent a lot of small businesses, and I'm sure a lot of you are involved with small business. And 99% of the time, the Corporate Transparency Act is going to apply to you. So I wanted to talk about that a little bit. Wanted to give you a quick disclaimer because I'm legally and ethically obligated to do so. But the long and short is, if you still have questions about the CTA, how it applies to your specific business at the end of the presentation today, it's always a good idea to reach out to whoever your attorney is and follow up with them. The applicable law, Corporate Transparency Act, also referred to as the CTA, House Bill 6395-1217, was initially proposed, I think, back in 2019 under the Trump administration or during the Trump administration, but it received bipartisan support. So support from both Republicans and Democrats, and I believe both the Trump administration and the Biden team were in support of the Corporate Transparency Act. It's part of the National Defense Authorization Act, which is an act that's proposed by Congress every year. And the Corporate Transparency Act was formally adopted with some changes to the original bill in 2021, with the understanding that it would not go into effect until January 1 of 2024, which is why we're just now talking about it today. Responsible agency, FinCEN, Financial Crimes Enforcement Network, is part of the Department of Treasury. They are the ones responsible for dealing with the Corporate Transparency Act, issuing the reporting requirements that we're going to talk about today. There's a reference to the underlying law if any of you are interested in reading through the lengthy rule in the Code of Federal Regulations. But we're going to try to touch on most of the main pieces of the act this morning. Purpose. The stated purpose, and you can speculate about what the government's really wanting to do here, but it's essentially is to require businesses and people to report to FinCEN about who owns and controls different business entities and other organizations. Next slide, please. The objective, they claim, is to try to thwart criminal activity, specifically money laundering, terrorist financing, those sorts of crimes, by having a better understanding of who's behind the scenes of these business entities. So the question is, who has to deal with this law? Who has to report their information to FinCEN? It can be both domestic and foreign entities. And when we talk about foreign entities, we're talking about foreign entities that are also registered to do business in the United States. Could be for-profit or nonprofit entities. We're going to get into that a little bit more. Not all nonprofit entities are exempt from this law. Most of the time, we're going to be dealing with corporations and LLCs. Those are the two most common forms of business entities, and any other state registered entities. So it depends on your state, and it varies from state to state on what kind of business entities actually have to register with the Secretary of State in that specific state. So it could also include certain types of partnerships, like limited partnerships or limited liability partnerships or other business entities. So 99% of the time, small business owners are going to be running a corporation or an LLC. LLCs are the most common form of business entity today because they're the easiest and the most streamlined and flexible entities. But a lot of older companies are corporations too. There are exceptions, and there's more exceptions in this, but certain financial institutions are exempt from these reporting requirements. Professional entities like accounting firms or insurance companies, law firms, interestingly, are not exempt from this requirement. So my firm has filed a CTA report, just like every other law firm is going to have to do. I'm not sure why the reason accounting firms are exempt and law firms aren't, for example, but that's how they've set it up. Tax exempt entities. So when we talked about nonprofits, not all nonprofits are exempt. When you think about nonprofits, you can be a nonprofit entity under the law of the state of Ohio, for example, but not be exempt from taxes under federal law. So what we're talking about here in terms of exempt entities are those entities that are exempt under federal tax law, not only 501c3 entities, but also other 501c entities, charitable trusts, and certain political organizations. Large operating companies, 20 plus full-time employees that operate in the U.S. and that have filed income tax returns reporting $5 or more million in gross U.S. sales or receipts. That's probably, I hope it applies to some of you, but it's probably not going to apply to most small family businesses. And every single one of those requirements has to be met for this exception to apply. Then we're talking about inactive entities. So a lot of people have old business entities that maybe were started by their grandfather or something that have not been active, aren't conducting business operations, but are still technically registered on the books with the state of Ohio, for example. Maybe it was an old corporation that was never formally dissolved. These entities are only going to be exempt if they're not actively operating, they're owned by a U.S. person, there haven't been recent changes in ownership, no recent transfers of funds, and no assets. So if you have an old business entity, but it owns a piece of property and there's rent being paid into that entity, then it's not going to qualify even if it really isn't doing a whole lot else. So what I'm recommending to people, if you have old business entities still on the books, registered as active with the state of Ohio, now would be a good time to think about dissolving those entities so you're not going to be required to file a beneficial owner information report for that entity. What's required when you file a beneficial ownership information report under the CTA? So the reporting company has to provide its legal business name, its trade name if there is a trade name, the U.S. address, which is a place of business, not just a mailing address, the state where it was formed, and so that's just kind of part one of the informational report. Next slide, please. Sorry, the tax identification number 2. It will need to be provided. And then for each of those reporting companies, you have to list 2 types of individuals, the beneficial owners and the company applicants. For both of those types of people, you have to list legal name, date of birth, U.S. address or residence, and personal identification information along with an image file for that personal identification. What does that mean? That means you put in all your information on the BOI report, but then you also have to upload an actual copy of your driver's license or passport, for example. And obviously, people don't like to do that, but it's what's required under the law. Next slide, please. Who is a beneficial owner? A beneficial owner is someone who is an individual who directly or indirectly, through any type of arrangement, whether it's a formal contract or something less formal than that, exercises substantial control over the entity and or owns not less than 25% of the ownership interest in that entity. So why that's important is because you can typically identify pretty easily who owns 25% or more of a company. The bigger question is, how do you determine who is exercising substantial control over an entity? And it's important to note that there's no limited number of beneficial owners. In theory, there could be 10 different people who fall under this definition, not because they own 25% more of an ownership interest, but because maybe they exercise that substantial control that we're talking about. So there's no cap on it, and this is where you have to really be careful about making sure that you're following the regulations and reporting who you need to report. I'd like to talk about a couple different examples so we can see how that plays out. Example 1, you have a U.S. limited liability company registered to do business in Ohio. So this is an example that might involve a lot of you. In this case, it's a member-managed LLC. What that means is the owners are the ones making decisions on behalf of the LLC. In this case, in this example, there's only one member, individual A, who owns 100% of the LLC. So who has to report as a beneficial owner for this company? The obvious answer is individual A. They're the only person who has management or control authority and ownership of the entity. So that's easy enough. Example 2, let's talk about a British corporation registered to do business in the state of Delaware. So even though that entity was originally formed in another country, it can register to do business in the United States. Therefore, it falls under the CTA. In this case, next slide or next paragraph, please. You've got a president, CEO, who's individual A, a secretary, individual B, a treasurer, individual C. The reason I point those 3 positions or offices out is because under Ohio law, for example, every corporation has to have a president, a secretary, and treasurer. So you're going to have someone who fills those 3 offices. Next paragraph. The shareholders in this corporation are individual D, who owns 50% of the shares, individual E, who owns 40% of the shares, and individual F, who owns 10% of the shares. So think about who of these different individuals will have to report their beneficial owner information under the CTA. The answers in this particular case is going to be individual A, because they have substantial control over their entity because they are an executive officer as president and CTO or CEO of the company, but also individuals D and E due to their ownership percentage in the corporation. Next example, please. Example 3. Another U.S. LLC. This time it's registered to do business in California. Next paragraph. In this case, it's a manager-managed entity. What that means is you have members who are the people who own the interest in the company, but then you have the manager who has control over the company. Manager is individual A. The members are individual B, who own a 75% interest, and individual C, who own a 25% interest. So again, think about the requirements of the CTA, looking at both ownership, but also substantial control. In this case, the beneficial owners who have to report include individuals A, because of their substantial control as a manager, but also B and C because both of them meet that 25% ownership threshold. Next example, please. And this is our last example for today's purposes. A limited partnership registered to do business in Arizona. I'm pointing out this particular example because in Arizona, limited partnerships, as far as I understand, have to register with the Secretary of State in Arizona. So it's a registered entity, therefore it falls under the CTA. The general partners, in other words, the partners who have control over the entity are individual A, who have 15% of the units, and individual B, who own 50% of the units. The limited partners are the ones who have an economic interest in the entity, but not necessarily control. So they're the more passive owners in the company. Those include individual C with 20 units and individual D with 20% units. Finally, individual E with 30% of the units. So in this case, we're thinking about, again, who has substantial control and who has more than a 25% ownership interest in the entity. In this case, the beneficial owners include individuals A, B, because they're both general partners with substantial control, and individual E, who has more than 25% of the ownership in the limited partnership. Next slide, please. So we talked about beneficial owners. The next type of person who would have to report their information under the Corporate Transparency Act are company applicants. Company applicants are individuals who directly file or register an entity with the state and or are directed or controlling the filing action. So I'll use my office as an example. So if I'm filing a BOI report for a client, then I'm the one directly filing or registering the entity with the state of Ohio. I have to report my information, even though I'm an attorney. But if client A is the one who told me to file the report on their behalf, they're the one who essentially directed or controlled that filing action. So individual A, the client, would also need to report their information as company applicant. The important thing to note is each company will have at least one company applicant, but no more than two company applicants. You can see how, if that were applied to all companies, regardless of when they were originally formed, how that would be a mess, because there may not be company applicants in existence still for an entity that was created in 1975. So this requirement to report company applicant information only applies to entities that are registered or created after January 1, 2024. Before that date, you do not have to report company applicant information. Next slide, please. Deadlines. This is a big one, so mark these down. For entities filed or registered with the state in which they're located prior to January 1, 2024, you have 1 year, basically until the end of this calendar year, so December 31st, 2024, to file your initial BOI report. So, if you think about all the entities or businesses ever created, 90 formed prior to January 1 of this year. So they're going to have a full year to file their reports, but you don't want to wait until the last second to do it, especially if you have multiple business entities that have to file reports. For entities filed or registered after January 1, but before January 1 of next year, so any entities created this calendar year, you have 90 days after creation or registration to file your initial BOI report. So they're giving you not the full year to file, but a little more than what the regular rule is going to require. Starting next year, however, for entities that are filed January 1, 2025 or after, you will only have 30 days after your business is registered to file your BOI report. And that's not a lot of time. And when you're busy setting up a business entity, dealing with all the practical, issues associated with that, it's something that could easily slip your mind. So you want to put that on your to-do list anytime you register an entity. Starting January 1, 2025, you have one calendar month to file your BOI report. The other important thing to note, if any of your beneficial owner information changes or any of the company information changes, you have to report those changes by filing a supplement to the BOI report within 30 calendar days of that change of taking effect. So let's say the ownership of your business changes. An individual A owned 50%, but then they sold their interest to two individuals, B and C, who now each own a 25% interest in the company that they didn't before. You have to file an updated BOI report to reflect that change in ownership within 30 days of that taking place. I hear this a lot. Clients don't want to report more information to the government. If you think about it as a practical matter, the government already has most of this information. I mean, part of what they're requiring is, personal identifying information, which they already have because everyone has a state-issued driver's license or a federally issued passport and that kind of thing. But it's, again, there's really no way around it. And next slide, please. The problem is if you just say, I don't want to cooperate, I think it's BS, whatever. Under this law, they've imposed some pretty intense fines and other penalties for not filing your reports. If you intentionally don't file your report, civil penalties up to $500 a day, that can really add up. Criminal penalties of up to 2 years in prison, up to $10,000 in criminal restitution and fines, and potentially along with that other charges. So if you're not reporting accurate information intentionally, you could be also charged with fraud or other federal crimes as well. Now, they're not trying to, hunt down anyone who accidentally forgets to file the report. So there's a safe harbor. If you accidentally report incorrect information or what have you, if you do so within 90 days of the original reporting deadline, then you're going to be okay. As a practical matter, it remains to be seen how strictly they're going to try to enforce this. If you think about the hundreds of thousands, if not millions of business entities that are going to have to report, they're not going to have the resources to track down everyone and prosecute them for not having filed timely. So what they're really targeting, I think, with a lot of these penalties are people who intentionally don't cooperate, but nevertheless, it's a risk. In my opinion, it's not a risk worth taking. Next slide, please. Filing, the practical stuff. You can go on FinCEN's website. They have a BOI web page where you can basically file your report electronically. You can obtain a FinCEN ID, which is what I did because I know I'm going to be filing a bunch of these reports for clients. So the FinCEN ID, I submit all my information up front with FinCEN. They give me a FinCEN ID number. And then going forward for each entity that I report for, I don't have to type out all my information, re-upload my driver's license and all that fun stuff. So if you know you're going to be filing multiple reports, it may make sense for you to obtain a FinCEN ID. You then file the BOI report, and it takes you step by step through the process. And there's a place where you can upload the image of your personal identification and that sort of thing. So, I think a lot of the time clients are going to be able to file these reports themselves, but thinking back to the issue of, who has substantial control over my entity, who's actually required to report their beneficial ownership information. That's when you really want to consider, do I need to consult with an attorney or other professional to help me figure that out? Summary of the process. We're getting close to the end here. Determine whether you have an interest or operate a reporting company, which is going to be 99% of small family for-profit businesses. Determine whether the reporting company was created or registered with the state. So in Ohio, all corporations and LLCs have to be registered with the state of Ohio. Sometimes other entities like partnerships may or may not have been registered with the state. If it's a sole proprietorship that's simply doing business as, through an individual, it's not a separate business entity, and it's not registered with the state, so it would not apply. Step 3, determine who the beneficial owners are and also who the company applicants are. Step 4 is to actually file the report reporting the information for those individuals. Next slide. And then obviously file your corrective reports or updates if you need to. Just some things to think about, and Dana's going to circulate these slides after my presentation. But it's not always as straightforward as it might seem. I know a lot of accounting firms, for example, are not filing BOI reports for their clients because there's potential exposure there. There's questions about, is that unauthorized practice of law? Do they really want to get in that business of doing that? We talked about trying to dissolve entities that are inactive so that they're not on the books with the state, so you don't have to file BOI reports for them, etc. One other thing I wanted to talk about, next slide. I had a client approach me the other day about legal challenges they've heard about on the news to the CTA. So like any law that's controversial, there are going to be lawsuits filed to try to strike that law down. This particular lawsuit, National Small Business United versus Yellen, filed in 2022 in Alabama. That's exactly what they did. They filed a lawsuit saying it's not enforceable under the Constitution. The important thing is the Commerce Clause under the Constitution gives Congress the power to regulate commerce. And their argument was, in this case, Congress is not really regulating commerce. That's not what's at issue here. Go to the next slide, please. Commerce Clause is the way Congress gets a lot of its power to regulate state business operations, right? So the trial court in the Alabama case found that the CTA was unconstitutional, and that the CTA itself, simply by having reporting requirements for businesses, does not regulate economic or commercial activity on its face. What does that mean for you guys as business owners or people involved in businesses? The CTA still remains in effect for everyone except is going to remain in effect for everyone except the specific plaintiff in that case and the plaintiff's members, while the appeal is pending with the 11th Circuit Court of Appeals, which covers Alabama. The 11th Circuit, it's worth pointing out, does not cover Ohio. Ohio is under the 6th Circuit Court of Appeals. So even if the court said that, it's unconstitutional as to everyone within the 11th Circuit, it still wouldn't apply to you guys in Ohio. It is expected that this lawsuit may make its way to the Supreme Court probably next year. So it's going to be a while before we get an answer from the Supreme Court. But there's speculation that they could potentially just revise the law to trigger the BOI reporting requirements for entities engaging in commerce so that it falls under the Commerce Clause and therefore will be enforceable. I don't know if we have time for any questions, Dana. If we don't, you can always reach out to me directly. There's my information, or you can reach out to Dana and he'll get the questions to me, and I'm happy to help try to answer those for you. Thank you, guys.
Thank you very much, Grant. Appreciate that. No questions in the chat at this time. So thank you again, Grant, for that information, and these slides will be shared. Overtime rule, we are privileged to have Mark Friedman, the Vice President of Workforce Policy at the U.S. Chamber of Commerce, joining us today to discuss the changes in the overtime rule, scheduled to take effect in two parts, the first part on July 1, the second part on January 1. Mark's extensive experience and insight will help us navigate this complex regulatory update and prepare for its implementation. Mark graduated cum laude from Amherst College and has his Juris Doctorate from Case Western Reserve University. Mark appears on various media outlets such as Fox News, CNBC, Bloomberg TV, National Public Radio, and his insights are also featured in print in the Wall Street Journal, the New York Times, and the Washington Post. Mark, thanks for being part of the Chamber's informational session today, and we'll turn it over to you.
All right. Thank you so much, Dana. Thank you, everyone. Good morning. I suspect some of you have been hearing about the new overtime reg because it is just about ready to take effect. So I want to cover some of the details in it and hopefully get everybody up to speed on it and get on the same page. So just a few sort of high-level points. It came out on April 23rd, and this is all about under the Fair Labor Standards Act, which is the law that gave us the minimum wage and overtime requirements. Any worker who works more than 40 hours a week must be paid for time and a half for any time over 40 hours. Note, California is different as they are in just about everything. Can I get the next slide, please? So against that requirement, the Fair Labor Standards Act contains a whole array of exemptions. The one that we're going to talk about today, or the category of exemptions we're going to talk about today, are called the white collar exemptions. These are for executive, administrative, and professional employees. And just to start off, in order to be exempt, an employee must meet all three of these criteria. They have to be paid on a salary, which means they get paid the same amount every week, regardless of how much work they're doing. The salary has to be above the specific threshold, which is what this regulation is going to change. And they have to meet the specific duties associated with those different classifications. We'll talk about the duties at the end of this presentation. There's also another classification, another exempt classification called highly compensated employees. This is sort of a last resort exemption. Basically, you only have to meet one of the duties requirements from any of the EAP classifications, but you have to be paid at a higher salary level. Next slide, please. So here's where we get serious. As you can see, July 1, coming up next week, is when the first salary threshold increase takes effect. So it's going to go from the current level of 35,000, a little more than 35,000, all the way up to 43, almost $44,000 a year. And the weekly breakouts are given there as well. You'll get these slides at the end. I've given them to Dana to circulate. And then, wait a minute, go back, please. We're not done yet. And then on January 1, it really jumps up. If you do the math between right now and January 1, it's about a 63% increase. It goes up to $58,656 a year, over $1,000, almost over $1,100 a week for the salary threshold for those exempt classifications, executive, administrative, and professional. And then the highly compensated employee thresholds go up similarly. Next week, July 1st, it jumps to all the way up to almost $133,000 a year. And then on January 1st, it jumps up to over $151,000 a year. So those are significant increases, and they're going to make a difference in terms of how many people are going to be considered exempt under these classifications. And then just to put some icing on the cake, as the Democrat administrations like to do, they've included an automatic adjustment mechanism so that every July 1st, this is going to get recalibrated and you'll see new numbers. The first one coming July 1st, 2027. So that's the basic salary threshold numbers. The point is that you have to be paid above that salary threshold to be considered exempt, and you have to be meeting the duties requirements. So next slide. Let's get into the duties requirements. And I apologize for all the text on these slides that are really dense, but I took this off of the Department of Labor information sheets, and there's really no easy way to describe this stuff. So if you're going to be considered exempt as an executive employee, then your primary duty, as it says here, it has to be managing the enterprise or managing some specific department. You have to be directing the work of at least 2 or more full-time employees. I broke out the term management there because I think that's the one that's going to get the most attention in terms of whether you are actually functioning as an executive. This is the kind of category where the tough cases are people like at fast food restaurants who get the title like assistant manager or something like that. And the question is, are they actually managing, or are they just an elevated, line employee? And that's where that analysis is going to be somewhat challenging. But under the term management, it includes a lot of different duties and things that you would associate with people who are running an enterprise. I think the key part there is the third bullet. The employee must have the authority to hire or fire other employees, and that they have input into those types of decisions. That's a pretty significant element of being an executive employee. Next slide, please. So the administrative employee is, I think, the one that is probably going to trip up a lot of people, or where you're going to have the most questions. As it says, you're performing office or non-manual work. But I think the second bullet is the one that really becomes an issue. Exercise of independent judgment with respect to matters of significance. And then I've broken that term out down below as the Department of Labor has described it. That's where I think a lot of administrative employees are going to be under some scrutiny with respect to whether they are truly or properly exempt. And this, to step back for just a moment, you may remember that in the Obama administration, they put through another increase in the salary thresholds, and it caused a lot of companies to go through who they had as exempt and really look closely at whether they met the duties test. So back in 2015, when that regulation came out, a lot of companies took the opportunity to really look closely at what they were doing. This regulation may cause some of those companies to go back or new companies to go back and revisit their questions of who's exempt. Next slide, please. And then finally, we have the professional employee exemption duties. And this really revolves around having advanced knowledge and specifically some type of schooling that goes with that. Note there at the very bottom of that description, advanced knowledge cannot be attained at the high school level. So you have to have some kind of education beyond high school to be considered a professional employee. We'll take the next slide. Next slide, please. So there's another category for creative professionals, and they have specific requirements around being, someone who uses their imagination and is responsible for being creative. Note there at the bottom, the discussion about journalists. They're not exempt as creative professionals if they only collect, organize, and record information that is routine or already public. So, if you're just a basic reporter, you may not be considered exempt unless you really put some type of unique or personal involvement into that work product. I think I have one more slide on these duties tests. So teachers, lawyers, and doctors, they're exempt as well. Teachers are exempt, as long as they're actually doing teaching duties. I think the theory here is that, of course, it's hard to put them on a clock when they're really working in various hours. And then, of course, if you're actually practicing law or medicine, not just have the degree, but actually practicing it, then you would be considered an exempt employee. I think that's all the slides I have. So a couple of thoughts here in terms of what employers should be looking to do at this point. I think the first thing is you need to look at your employees and identify how many people you have who are classified as exempt. And then look at their salary thresholds and look at their salaries and see how they match up against the thresholds. In some cases, it may not be a big deal to increase them so they above the threshold so they stay exempt. In some cases, that's going to be a big lift, and you may have to decide whether you want to maintain their exempt status, or what happens is people get reclassified, and that means they're on the clock. And you have to track their hours and then make sure or watch if they get over 40 hours a week. The interesting thing about this discussion is what we've learned over the years when these changes have come on is that a lot of employees resent and don't want to be reclassified. They enjoy some of the flexibility that goes with having a salary. They can, in some cases, decide when they're going to work and be able to take time off for personal duties without losing money. A lot of employees consider it a professional or some type of elevated status to be on a salary. They don't want to be tied to a clock. The Department of Labor's view is, well, these people are losing money by not being able to earn overtime. The reality is that if you're on the clock, employers are probably going to watch your time pretty closely and not let you earn overtime or be very careful about whether that employee earns overtime. And so the first step is to identify who you've got who is exempt. The second step is look at their salaries and see how they match up against the new thresholds and decide what moves you want to make on that. And the third step I would say is, for anybody you want to keep as exempt, look closely at their duties and how they're performing. Make sure that those duties are in line with the duties test that the Department of Labor has described. And here's a little note. Titles mean nothing. You can call someone an assistant manager or a manager or whatever you want to call them, but unless they're actually doing the duties that are described in the duties test, they don't get the benefit of that exemption. You can't just mask it over by calling them something that looks like it's a professional title, but in reality, they're not performing the duties. So you have to be very careful there. The way this is going to get enforced, the Department of Labor will start conducting audits on employers that they think may be in violation, or an employee can call the Department of Labor and say, hey, I think I've been misclassified. I think you need to come in and look at this and assess the situation. And then the penalties for this are the back wages that the Department of Labor determines should have been paid. So if someone has been classified as exempt, but the Department of Labor determines that they didn't meet the duties test, which is typically the problem, they will go back and look at how long they've been misclassified and determine what they should have been making during that period and assess those damages to the employer, as well as what's called liquidated damages, which is a multiple of the amount that the employer owes the employee. And they're pretty serious about making that stick, so it can get expensive very quickly. And as I like to say, there's no such thing as a single plaintiff here. If you've been misclassifying an employee, chances are you've been misclassifying other employees. And you can get into some pretty serious checks very quickly when you start talking about multiple employees that were misclassified. So it's it would be a good move for companies, particularly this week before July 1st, to figure out where they stand with this with their exempt employees and figure out which ones need to be adjusted or whether they want to adjust them. July 1st is going to come very quickly, and then of course January 1st is going to be a whole nother question, and that's going to be a really serious hit. This regulation is being challenged in court right now by a broad coalition of employer groups. I don't have any way to know whether it may get stayed before it goes into effect next week. There are some cases that have been brought that are asking for that stay, but I can't tell you, I can't sit here and predict which way that request is going to go. So with that, I think I've run out of my slides, and I'm happy to take any questions or comments that you all may have.
Well, Mark, on behalf of our chamber, we thank you and your team for the work that you do there in DC for the benefit of the businesses throughout the United States. And I know our office works closely with your Chicago office, and we always receive good information that we share with our members. I have put a post on there asking anybody if they have any questions for Mr. Friedland.
Friedman.
Friedman, excuse me, my apologies. I know that. I typed it wrong.
But I do believe in us having a freed land.
Yes, very much so. And as stated, this information, this presentation will be shared with our members via our newsletter. We'll also put a link to the Department of Labor information sheet on there. Here we go. We have
Someone
a
has
question.
come in. I was waiting for that. I thought someone might ask that question. There are provisions for allowing commissions to make up, I think it's 10% of the base salary. So you can get some credit for a commission, but it can't be only commission. Or put it this way, you're not going to get the full benefit of that commission towards the salary threshold. So you get like up to 10% of that salary threshold can be made up by commissions. All wages included in the total amount or only the base salary. I'm not sure what that would refer to. The point of the salary is that you're paid the same amount each week. Bonuses. You're paid the same amount each week, regardless of how much work or productivity the employee has. Bonuses can be included, but they have to be something that isn't discretionary. So if an employee is going to earn a bonus because they do a certain amount of work and they know they're going to get that bonus, then that I think can be included. But if it's something like the boss says, hey, you did a great job this week, I'm going to throw you a couple extra $100, that can't be included because that's just discretionary and not predictable. And there's a whole separate regulation that talks about what is included in regular rate of pay. So the overtime law says you have to be paid 1.5 times the regular rate. And what goes into that regular rate is described in a whole nother regulation. And sorry to get technical and boring. And in that regulation, it discusses things like bonuses and other benefits that employees may receive. And also the, how all those other things would be calculated into the regular rate.
Mark, we appreciate your insight. Any more questions for Mark?
Wait a minute, I see something else here.
Yeah,
what if
just popped
based on a percentage of revenue or net profits, which can fluctuate or vary in pay? I'm not totally sure on this question. I think again that goes to the regular rate regulation, but I'm going to sort of take a wild guess and say it has to be predictable in order for the employee, in order for that to be considered part of the regular rate of pay. And again, you only get a certain percentage of that salary being able to be made up to that contribution. So you can't just say, well, they're making over the salary threshold because they get X amount of money in bonuses and commissions. That only can be a certain percentage of the overall salary basis. But, and this is, to repeat the suggestion of our previous speaker, this is where working with a competent attorney is a good idea. First of all, let me give you my basic disclaimer. I'm not giving legal advice. Don't go running around saying Friedman from the chamber told me to do this. You need to be working with your own, HR professional or attorney who knows these matters closely and can actually advise you in terms of the nature of your business.
Well said, Mark. Well said. And thanks to Mark and Grant for taking time out of their busy schedules to enlighten our members on these two very relevant topics. So if there's no more questions, we will wrap this session up. And again, Mark, thanks for joining us today from DC, and Grant, thanks for joining us from downtown Zanesville, Ohio. So have a great day, everyone. Take care.
All right. Thank you all. Bye-bye.
Thanks, Dana.